Hi, this is Jon May. You know, the number one question people ask me as a realtor is, how's the market? And that answer is always, well, it depends. The number two question is, should I pay off my mortgage early? Well, again, that depends. Do you have savings? Do you have zero other debts? Then you're facing a vexing, age-old dilemma. Should you invest any additional savings, or should you use that money to repay your mortgage? Now, let's assume that you're debt-free except for your mortgage. You have an emergency fund that's tucked away safely, you're making retirement contributions, and if applicable, also saving money in your children's college savings account. On top of this, you're able to save a little extra money, even if it's as small as $50 or $100 per month, and you're not sure how you should handle these funds. Should you invest this money, or should you maybe accelerate the repayment of your mortgage? Let's explore the arguments for repaying your mortgage versus investing. The case for repaying your mortgage. Number one, less money consumed by interest. Making extra payments on your mortgage holds a guaranteed payoff. You're certain to save money on interest payments. Depending on how aggressively you repay your mortgage, your savings could total thousands, if not tens of thousands. Let's assume you borrow $200,000 on your home at 5% interest rate with a 30-year fixed rate mortgage. The principal and interest comes in around $1,073. Now, it's not including your escrow. Now, let's also assume that you add an extra $100 to the monthly payment applied towards principal starting from the first payment. This simple measure by itself results in the mortgage getting repaid more than 5 years early and saves $37,000 worth of interest over the life of the loan. That's a pretty compelling case for using your money to accelerate your mortgage. Argument number two, increased cash flow. The faster you finish repaying your mortgage, the sooner you'll have access to additional money that you can use for future investments. In the example, you'd finish making mortgage payments more than 5 years ahead of time. During those final 5 years, you can make a payment to yourself every month and invest this money instead. You'll be able to gain exposure to the market without the additional risk that comes from having a large debt on your personal balance sheet. Number three is forced savings. People aren't perfect. It's easy to debate the relative merits of investing versus repaying the mortgage. But what's the likelihood that you'll actually invest the money? If you might spend those funds on a vacation in Hawaii instead, then it might be worthwhile to set up monthly automatic additional payments on your mortgage. In case number four, would you borrow to invest? Here's a mental exercise that might prove enlightening. Let's imagine that you have significant equity in your home. Would you borrow against that equity and use that money to invest? If the answer is no, then rationally, you shouldn't prioritize investing over repaying your mortgage. After all, each dollar you put into the market is a dollar that you're borrowing via your mortgage. Every investment carries an opportunity cost. Now let's talk about the case for investing. That said, there are several strong arguments for investing this money as well. Number one, investment returns could be higher than the interest rate. Many discount brokerages, including Vanguard and Charles Schwab, offer low-fee index funds that allow you to invest in the overall U.S. market rather than investing in a specific company like Google or Nike, which can be riskier. You can invest in the overall market as a whole. The U.S. broad market historically returns 7 to 9% over the long-term annualized average. Now, if your mortgage carries a low fixed interest rate, like 4%, in theory, you could be getting better results investing your money and pocketing the spread. For example, you might borrow money via your mortgage at 4%, hypothetically earning 8% gains, and keep the 4% difference. Over the span of 30 years, this could total a significant amount of money. There are two disclaimers here. One is that past performance is not an indicator of future performance. We don't know what type of returns the market will produce moving forward. The second is that most investors are their own worst enemy. People have a tendency to panic sell during downturns, turning paper losses into real losses. Long-term gains are contingent on sticking to a buy and hold strategy. Argument number two, inflation is a mortgage holder's best friend. If you have a fixed rate mortgage and the country proceeds with normal rates of inflation, you'll increasingly make payments in cheaper dollars over time. So for example, your monthly principal and interest payments are fixed at $1,200 a month. Today, that $1,200 a month can buy around a round-trip airfare to New York or London, a fancy purse, an Apple laptop, or a dozen nice restaurant dinners. However, 30 years from now, that same $1,200 will have substantially less purchasing power. It may only buy you domestic airfare, for example, or 2 or 3 restaurant dinners. By holding on to your fixed-rate mortgage during an inflationary period, you can repay the debt in cheaper dollars over time. And by investing, you can take advantage of inflation-driven gains. What's the better option? Investing or repaying your mortgage? There's no right or wrong answer. Personal finance is just that. It's personal. So you'll need to take a careful look at the arguments on both sides and make the decision that's most comfortable to you. Now, if you'd like to invest in real estate, you should download my free ebook called Foreclosure Home Buying Secrets. You can get it at www.freehrforeclosurebook.com. If you like my videos, subscribe to my YouTube channel and they'll be sent to you as they're made.